Hello everyone, this video is going to break down why we need to move away from CPA in Google Ads towards a new metric that is back-end verified, how we do that, what we use it in relation to, and the next steps. Real quick, I'm Kieran, I'm the founder of Chiesa Growth, a freelance Google Ads consultancy working specifically with UK D2C brands trying to grow profitably. This video is going to break down all about NCAC. So, cost per acquisition, why is it? Why do we use it? It's simply put, it's easy, it's in platform, it's a bit like ROAS. It's quite understandable for clients and for SLT. I think everyone's just got quite used to reporting on it when actually there are better alternatives out there. Someone lands on your website, then they go out and check out and buy. They could consent is they're tracked, or they opt out consent mode models in the sale. You can then report based off in-platform performance, how efficient you are, client's happy, client understands, easy peasy. The problem with this is it's modeled right now. Lots of data in Google Ads is actually not the truth. It's what Google thinks has happened. It's a best estimate with advanced consent mode. So it's not actually the truth, number one. Number two, your cost per acquisition or transaction every time the tag fires has no insight into margin. It doesn't tell you anything about whether that sale was profitable or not. And importantly, a transaction or cost per acquisition each time the tag fires is not the same as acquiring a customer, let alone a new customer. On top of that, you've then also got to layer in the fact that Google can only report, or Google Ads can only report from what Google Ads interacts with. It has no idea whether the demand was created from Meta and Google's just harvested it, and vice versa. Meta does the same thing. So Google Ads in platform always looks really rose tinted, and you think everything that's done in the platform is what Google's created, and that's not actually true. So you've got these three big issues here that make cost per acquisition quite rose tinted and quite limited in what is actually happening in relation to business performance. It looks easy in platform, but it doesn't actually tell you the truth. How do we combat this? We should look to use NCAC, or new customer acquisition cost, which is a lot better, but it's shifted out of the platform. So what actually is that? Simply put, is your total acquisition cost divided by the number of new customers you've acquired, verified in your backend. And when we say total acquisition costs, we do not mean ad spend. What you're using in platform is just taking your ad spend and dividing by the number of conversions you've got for your cost per acquisition. This takes it a step further, and it says all your paid media spend, or you could limit it to Google Ads if you wanted to get a Google specific one. On top of that, you need your agency or freelancer fees, or if you're in-house, the internal headcount costs that you have. So if you've got one paid search specialist working the account, you take their salary costs as the inverse of agency fees. Any creative production costs, if you're running full asset PMAX and you've had to shoot new assets to add in there, or copywriters fees, they go in there too. Any attribution tools you're using, all of that are fees that hit the P&L, hit your margins that need to be factored in. So when you only look at ad spend, you're missing that, and it makes your efficiency metrics look better than they are. And then you have to divide it by your new customers, not how many times Google's tag fired, whether the customer is new or repeat, it doesn't matter. It has to be new customers. It has to be verified in your backend, in your CDP, in your first party data. So you've got a very clear, true understanding of how many new customers you brought in with your total acquisition spend, not just your ad spend. So why do we use NCAC over CPA? Well, you can use it in relation to your margins, number one. You'll know exactly, when I show you later, what to use that number against. Is it profitable? Is it unprofitable? You're safe from platform bias. You don't have any consent mode modeling, which might be over generous and not actually tell the truth. You also don't have to deal with specific campaigns looking better than one or another because you've zoomed out. You're looking at back-end P&L focused. One campaign in Google Ads might look really profitable and look like a top performer, but DDA will always naturally sort of swing towards bottom of funnel more, makes it look better than it actually is. So you're safe from that. You're also safe from Google cannibalizing Meta's demands and vice versa. So you haven't got to say both channels report a sale, but there's only one sale. You haven't got that issue. You're safe from that. You're using the new customer verified data in the back end. It helps also convey a really simple story to SLT and your founders. So last month, total acquisition spend was this. We brought in this many new customers, this much spend, this cost per true new customer. Is it profitable? Yes or no? Can we spend more? There we go. And it's all from the back end. It's your truth, if you like. It's not relying on a platform that has best estimates and built-in biases. So To help make this easier, here's an example. In platform, you report that you've spent 12 grand last month on the account. It brought in 120 conversions, just transactions. Your return on ad spend was 4.2. Great. Your cost per acquisition looks really efficient at £100. But actually, in reality, same spend. You then add in the extra acquisition costs that you forgot to model in. There's your total cost, 13.5. Your new customers of that 120 were only 45. And before you go down and look at the performance, your contribution margin per order before the ad spend would be £126. You then factor all of this in. Your true new customer cost is £300, and therefore you're not making money. You're losing money. You thought you were acquiring each customer or new customer or cost per acquisition at £100. In reality, cost per new customer is over £300. You are losing money each time. Now, that's not a problem if you're trying to clear warehouse stock and you don't care about losing money. You're just trying to free up cash flow. But in most businesses, in most SKUs, you are trying to be profitable. This is a prime example. You're losing money per new customer. Now, this applies mainly in this example for businesses who are largely first order only. A lot of businesses, premium ends, furniture, jewelry, lighting, they don't tend to rely on LTV as hard. Some do, some don't. But generally speaking, first order businesses, you need to be profitable on that first order. Yes, subscription brands, supplement brands, they can all get away with LTV and lose money on that first order. For a lot of businesses, especially with margins shrinking, you want to make sure that every new customer you get, you're profitable on that first order. So if we now know what NCAC is, why we can benefit from it, how do we use it? And I say there's two approaches here. There's one is a blended single figure approach, like you did for your account cost per acquisition. You could, as long as you can know your blended business margin average, you can work out, is your NCAC higher or lower? How much you're spending to acquire a customer? Is it higher or lower than the amount it costs to produce the products overall? If it's lower, you're making money. If it's higher, you're losing money, blended overall. And this is a much better out of platform version than your CPA. But a lot of businesses, you have a wide variance of margins, especially in high AOV. If you sell a sofa, you sell cushions. Your cushions are going to be at a tiny fraction of the margin of the sofas. You might have a 40% contribution margin on your sofas. You might have a 10% on the cushion. You can't treat them the same. Yes, you can have a blended single figure as a high level, but you should split these out by cohort bands as well. So then that way you can say, I can spend this much to acquire a new sofa customer, this much for a table customer, this much for a cushion, and split it out that way. So you've got all these different NCAC figures. This just allows you to report much clearer on new customer volume, new customer acquisition costs, and profitability. So where do we take this? Because it's great you have an NCAC figure, but it should never be by itself. The problem people have is they treat CPA or NCAC or even CAC, which is just new plus repeat blended together, and they call it a day, which is half the problem. You need to then look at it and say, in relation to what? But it should always be NCAC in relation to my margin. How has that improved? How has that weakened? Are we driving more sales from it? Is it profitable? Can we afford to loss make? It should never just be by itself. It should never just be our NCAC was this. So you can look at it and say our NCAC was profitable blended at SKU level. We're profitable here, which is the plan, or we're unprofitable in this category level, but this is what we're doing. And fundamentally, a rising NCAC is never a bad thing. It's not always guaranteed to be bad. There can be times where your NCAC has risen by £100 week on week, but you've shifted more profitable items, which naturally you have to spend more to shift into a new customer because they're a bigger ticket item. For example, your NCAC, if you're selling lots of cushions but not a lot of sofas, your NCAC will be very, very small. The moment you start shifting more money into the sofa, which is naturally a more considered purchase, your NCAC will rise, but you'll have more profit, might even have better LTV with it. So it's not necessarily a bad thing. So where do we go from here? I think as a business, you need to understand your margins more than ever at a blended level and at a SKU level profitability example. And the way you can do this, there's lots of calculators out there, but I'm obviously going to plug my own. I have built my own, or I built about 7 different unit economics calculators for different verticals. So I will drop the links in the description. and then you takes 3 minutes, less than that even. You just put in your key data, your AOV, your discounts, your return rate, your acquisition spend, and you can see in real time and then model different scenarios whether you are profitable or not, based off your contribution margin, and then you can then make decisions whether or not you want to scale. On top of that, I'm also offering 20-minute profit lead consultations. We can go on a call together, screen share, and see in real time where you are losing money, where your opportunities lie, what it's costing you, and what I would fix first.